Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, May 3rd. How you doing? Hey, I hope you're doing well. I hope you had a good week. Hope you're having a good weekend, and I really appreciate you coming to my weekend review podcast. Boy, big week for the bulls. Uh, this market seems to only want to go straight down or straight up, but that's fine. We'll have to deal with the markets that we have, right? So, the format today for the podcast is, first of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the positions that I have, all of the trades that I made in the previous week. We're going to talk about when I entered the trade, why I entered the trade, what the signals were, what the confluences of signals were. Um, and then we're going to talk about how I position size correctly, how I place my emergency stop, how I place my end of day stop, how I take partial profits if the market moves a certain amount each day, and then how I am going to finally exit the position if it gets to significant overhead resistance level. So hopefully this will be helpful for you, give you an idea of, how I look at trading, how I put everything together of why I take the trade, and then how I manage the trade going forward, which is most important. The main thing in trading is you want to get out of your losers quickly, but then you want to have a plan that keeps you in a trade if it starts to move your way. That's the big, that's the overarching premise in trading, is you have to get out of losers quickly and you have to stay in winners. But unfortunately, it's kind of human nature, actually, that we want to take winners quickly because it feels good, and we want to not get out of losers because we feel like, oh, it's going to come back, it's going to be okay. And a lot of times it does, but there are certain times where it doesn't, and that's a rocky road. And all you need is one or two really bad ones, and you're not in a good position. So just overall, just in general in trading, you have to get yourself a process that allows for you to get out of losers quickly, stay in winners, but you need a process to follow so that you don't make decisions just based upon how you feel at any random day at any random time. I've been trading for over 30 years now, and every day, the longer I trade, the more I know this is true. So, whether you learn a process from me or whether you learn it from someone else, most important part, or the first part, is, yes, get your process, and then the second part is follow the dang process, right? And that's a challenge unto itself. But anyway, so we'll talk about when I entered the trade, why I entered the trade, and most importantly, how I am going to manage the trade going forward. After that, we're going to talk a little bit about trader psychology, most important skill in trading. Think about what I said. The most important skill in trading is the ability to create a plan and follow it. That's it. But that comes down to psychology, and that comes down to having a plan and following it. So I like to teach trader psychology. It's always important and helpful for me, and I hope it will be helpful for you. And if there's anything in this podcast that you do find of value or you find helpful, I really would appreciate it if you could hit the thumbs up button. It does help the channel, lets YouTube know there's some valuable content, helps keep the channel around and keep it growing. So if you could do that, I would certainly appreciate it. After that, I did go over my master watch list last night, Friday night. I always do it on Friday nights. I go down through each and every single one of the markets on my master watch list, and I look for potential trades for the upcoming week. Now, these markets that I've identified, they are not where they need to be yet. But if they get there, I will consider taking the trade. But, I always suggest this to my students and to my clients. Go through your master watch list on the weekends, look at the charts and go, boy, you know what? If this stock, whatever, Apple, were to get down there, then you would have a 200-day moving average. You may have a bullish MACD divergence. You may be in the low 30 RSIs. There may be an order block, right? This is one of the biggest advantages you have as a retail trader, is the ability to be patient and wait for a stock to come just into that perfect level that makes sense to you based upon the indicators you're using. Even if it gets there, it doesn't mean that it has to be a profitable trade, obviously, but it will dramatically increase your chances. Large financial institutions, they have to always be in the market. As retail traders, we do not have to. We can stand at that, in the baseball park, we can stand on the plate and wait for the perfect pitch to come. But even in baseball, the perfect pitch doesn't mean you're always going to hit it, but it helps, right? It's better than a slider or a sweeper or curveball, right? So, this is really what I'm suggesting to you. Go down through your watch list, look and go, God, in a perfect world, if this stock got to there, then there would be 1, 2, 3, 4, maybe there would be 4 potential signals of support and entry signals. And if you do that, you're going to be a better trader. You're going to have better results. And so that's what I'm doing here, and that's what I'm going to go over. I have gone down through the watch list. I have identified some potential trades next week that if they get to these levels, and I'll point out where the levels are, then that would make sense to me as far as the way I trade. So I hope that's going to be helpful for you. And so let's get started. Let's get the legal disclaimer out of the way quickly, and then we'll get started. So hang tight for about 40 seconds. Thanks.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
Okay, let's get started on the current positions and all the trades that I made last week. So this is QQQ. This has been a really, really good trade. I bought this very, very near the bottom. If you remember, I've been following the channel. I bought this all the way back here on the 8th of April when the world was coming to an end, if you remember, with the market. So, you look here and you see this green box. What is this green box? Well, it had everything to do with why I entered the trade. And, kind of as a little aside, if you were watching the news and following the markets back down here, you really thought the world was coming to an end, right? Because of the tariffs and all this kind of stuff. But just want to make the point that in my opinion, the way that I look at it is, I don't care what the news is at all. I care about how the market reacts to what's going on and how it reacts to potential levels, because down here you're never going to have any good news, right? But the market will show you if it starts rejecting certain levels. So this is an order block, and let me take you all the way back and show you what this order block is. This was an order block right here where I took the trade. If we go back in time, this order block goes all the way back to, let's see, 4/19 of 24. So about a year ago, I based my trade upon a level a year ago. So this is an order block. What's an order block? Well, an order block is the lowest bar close before you make a structure change. So the first thing that you need to have in order to determine all this is you need a swing low. This is the swing low over here. You need to have a rally, which we have. And then you need to come down and you need to make a lower swing low. So would you agree that we have a low, we have a rally, and then we have a lower low? As soon as that happens, you look to the left for the first swing high. Here it is, 444.18. So when you have your low and you have your high and you have your lower low and you've identified your swing high, Doesn't mean you do anything. All it means that in the future now, if you take out or you go above this swing high, now it changes the market structure from a bearish market structure to a bullish market structure. And look at this right here, this day on the 15th, when it finally blasted above this swing high, everybody saw it, and we had that big day up. So now that you've changed market structure to the upside, I'm looking here for the lowest bar close before market structure, or the lowest bar close after market or before market structure change, and here it is. Here's the high is 422.75, the low is 413.07. So the high and the low of this order block moving all the way forward into the current time of where we are now, that is an existing order block from a year ago. And you know, with my students, I taught a lot this week, and I was teaching order blocks, and I pointed out that look over here, you know, 2 months later, look how high we were. If I here in hindsight, or now in hindsight, if I look back, was the smart money buying here? There are people selling for sure, but was the, you know, in hindsight, when the market's this high, if we look back, was this smart money buying here? Well, 100% it was. You know, I don't think that's even debatable. If when you're close to all-time highs and you look back, the people that were buying here, it was smart money. So in the future now, if we come back to that smart money area, that might be a time to take a look. Now, it was smart money here. Does it mean it's smart money in present time? Maybe, maybe not. Things change, right? Politics change. The economy changes. So you don't know. But you know that smart money bought here last time. So again, this is 419.24, lowest bar close before market structure change. I run these levels all the way back into the future. You can see, look at this. Look at this pullback. It didn't quite get to the top of the order block, but pretty dang close. There were buyers there near that order block again. Then we had this big rally. So let's get to current time. And here's that order block from a year ago. So why did I enter this trade? Well, I entered this trade on the 8th of January, March, April, because we rejected the bottom of the order block. With order blocks, you can take a rejection of the high of the order block. The previous day, that would have been a legitimate trade too, because it went in the order block, closed above it. I didn't take it for that day for whatever reason, but I took it the next day. The day that during the day we went below the order block and then closed back into the order block. Okay, so that was my entry. I got in at 416.26. Now, when I decide I'm going to enter, the first thing we need to do is decide how many shares am I going to buy? And this is extremely important. It's probably the most important part of your trade is how many shares do I buy? Because if you buy too many, you know, you're in trouble. If you don't buy enough, then it doesn't even matter. So I'll show you the formula that I use, and it's based upon two things. It's based upon how much money do I have in my trading account, number one, and number two, what is the volatility of the market? So let's just say I have $100,000 in my trading account. I take 1% of that. That shows me what my maximum allowed loss is. If I have $200,000, my maximum loss is $2,000. If I have $50,000, my maximum loss is $500. But let's just go with $100,000. So I take hypothetically $100,000. 1% of that is $1,000. Then I look to the value of the 2 ATR. An ATR, average true range, that is how much the market is expected to move on any particular day on average, and I take 2 times that. So right now, the average true range is 36.94. So I take 1% of my total capital, $100,000, 1% is 1,000. I divide it by the 2 ATR, which is 36.94. that is telling me for the way that I trade, the correct amount of shares to buy based upon my account value and based upon the volatility of the market is 27 shares. Okay, so let's just say I bought 27 shares down here at 416.26. Now the first thing I do is I place my emergency stop. That is the red line here. Now what is that? That's exactly the 2 ATR value, right? So I take my entry price, I look at the 2 ATR value, I minus that from my entry price. This is now my emergency stop. So the reason that we did the math, if I have 27 shares and it moves down 36.94 shares, how much have I lost? I've lost $1,000, right? So I'm planning for the worst case scenario with my emergency stop. If I hit the 2 ATR, if I hit the emergency stop, I lose 1% of my account. Not fun, but you can survive from that, right? You need a level where you say, okay, that's it. I'm totally wrong. I'm out. I cry uncle, right? But the good news is that only happens about 5% of the time. The other 95% of the time, when I have a loss, it will be a smaller loss than the emergency stop. The emergency stop's worst case, right? But the other 95% of the time comes down to my end of bar stop. And your end of bar stop is different on every single strategy, right? I trade 7 different strategies, so it's different. But on this particular trade, my end of bar stop was simply a close below the order block. Look, I took the trade because it rejected the order block and closed back in the order block. So if the next day it had simply closed below the order block, I just would have been out of the trade, right? For most likely a fairly small loss. Maybe my worst case scenario was 1%, right? 2 ATRs. So we have the rejection of the order block. I position size correctly. I placed my emergency stop 2 ATRs below. My end of bar stops at close below the order block. Now the next thing I do, once I enter the trade and I have know where my stops are, I look at the value of the 1.5 ATR. Right now the value is 27.71. So I take my entry price and now I place a line 1.5 ATRs above my entry. This is my trailing stop mode. And all this means that is if I get to the trailing stop mode, now in the future, if I have a close below a previous bar's low, I'm going to get out of half of the trade. So you can see I bought here 416.26. The very next day, blast off to the moon. Okay, did I get to my trailing stop level? I certainly did. All that means now that in the future, if I have a close below a previous bar's low, I will exit half. So everything I've talked about so far as the position sizing, the emergency stop, the end of bar stop, going into trailing stop mode, these are all defensive moves. Or in other words, if the market goes against me, I am going to have to take some defensive action. But I also like to play offense in my trading. And the offense portion comes into taking partial profits if the market moves a certain amount each day. So I am in this trade at the moment. Let me show you how I determine or how I play offense. If I can find my calculator. Here we go. This is based upon the closing price for the next day. So right now on Friday, we closed at 488.83. So what I do, and I do this every day, I take the closing price, 488.83. Then I look at the value of the 0.45 ATR. Right now, the value of the 0.45 ATR is $8.31. So I take the closing price, 488.83 plus 8.31. My first profit target for Monday is 497.14. So I'll put the line 497.14. It's my first profit target. I'm going to place 3 every day, but this is how I came up with my first one. Closing price plus the value of the 0.45 ATR is 497.14. Then I do it again. 497.14, again, add the 0.45, which is 831. My second profit for Monday is 505.45. 505.45. I'm going to do it one more time. My second profit target, 505.45 plus 831, 513.76. 513. $76. So the question is, their profit targets, how much do I take off at each profit target? However many shares I go into the day with, I take 10% off at each profit target. So if I go into the shares with go into the day with 100 shares, 10, 10, and 10. If I go into the next day, I have 50 shares, 5, 5, and 5. And the more the price goes up, and the more profit targets that you hit, your amount of shares is going to be lower and lower and lower each day. And so therefore your profit targets, the amount that you sell at each 10% profit target, is going to be lower and lower and lower each day. But just as in sports, you have to play offense and you have to play defense. Trading is a sport. It is important, at least in my opinion, to take partial profits when the market gives them to you. All right. So let's just kind of start one more time quickly with the trade. And as we get onto the other trades, I'm not going to spend this much time. I just wanted to lay this first one out. So again, rejected the bottom of the order block. I got into the trade 416.26. I placed my emergency stop 2 ATRs below. My end of bar stops a close below the order block. I placed my 1.5 ATR trailing stop level, and of course, if the next day it moves at least the value of 0.45 ATR, I will start taking profits. Okay, the next day was a monster huge move up. I think it was the third largest move in the history of the stock market, if I remember. So you can see, did I hit 3 profit targets? Yeah, actually, I think I hit 7. I placed 3, but if my third gets hit, I go more and more. So on this bar up, I exited a lot of the shares and large percent of the shares, and I got to trailing stop level, which means now in the future, if I have a close below previous bar's low, I get out of half. Next day was down, nothing happened. Next day was up, I hit a profit target. Next day was up, I hit a profit target. Next day did nothing, no profit targets. Next day is the first time we close below a previous bar's low. What do? However many shares I have, I sell half, and I sold half for a gain of 6.75%. Selling half is one of the only win-win situations in trading. If you sell half and it keeps going down, you're glad you sold half. If you sell half and it goes up, you're glad you still have half. See? So next day down, next day nothing, next day down again, no profit targets, anything like that, and now we have another up move. Profit targets, profit targets, profit targets. I don't think I hit one there. No profit targets, no profit targets, no profit targets, profit targets, and profit targets. So right now, this particular trade, the remaining shares that I have, up 14.92%. Massive, massive trade. So what do I do going forward? Well, right now we're at a 60.75 RSI. So I have a lot of rules, right? I have a lot of rules for the different trading strategies that I use and that I teach. The rule at this point now is that if we're at 60.75 RSI, if I get to the 65 RSI level, then I have a rule that comes into place, which means, look at the 5 EMA. See the 5 EMA here? If I get to the 65 RSI level, now the 5 EMA comes into play. And if I have a close below the 5 EMA after reaching 65, I'm completely out of the trade. If it continues to move up, I'll continue to take profit targets. If it rejects the 70 RSI, Then I have a rule where I take off another half of the remaining positions. And then how do I get out of the entire trade? If I have a close under a previous bar's low after rejecting the 70 RSI, now I'm completely out of the trade. All right, and this is what I've been doing for years. This is what I teach my student. These rules are there for a reason. They work. And by the way, if you would like to study with me, I do teach private one-on-one lessons in the evening time. I've been teaching them for years. I've taught people from all over the world, from absolute beginners all the way up to the hedge fund level. Actually, I taught 4 times last week. So I have a lot of students at the moment, and it's really great to see them be able to learn this and for them to have aha moments. And so if you are interested and you want to learn, or you want to do the one-on-one course with me, it's 15 total hours. I teach you all 7 of the different trading approaches that I use. You're going to learn a skill that you can have for the rest of your life and use for the rest of your life. And I'd love to have you as a student. I'm a good teacher, I promise. And when you're done, you're going to be a much, much better trader. So if you're interested, my email is in the link of this YouTube video. Just send me an email and we can get the conversation started. All right, so that's the trade here, right? If it keeps moving up, I'm going to continue to take partial profits. If we get to the 65 RSI level, the 5 EMA will come into play. If we get up to the 70 RSI, and reject it, then I'm going to take half. If we just head straight down, well, I stay on that too. But the nice thing you can see here is that as it has moved up, I continue to take partial profits. And boy, was that order block a great entry. I love order blocks, really. I love order blocks. They're so strong. Doesn't mean they work every single time, but they sure work a lot more than they don't. And, I just want to take you back to the entry. Had it closed the next day, even 1 penny under that order block, okay, I take a little loss. But you have to get into trades where you have some big upside potential, because you are going to have a lot of losses. The key is they need to be small, but eventually you need to have some big wins to pay for all the little losses so you have something left over. So that's the cues. The remaining shares up 14.92% on that order block trade. All right, let's go to MA. I had an email from someone that says, Greg, I've been watching your podcast. Do you ever have any losing trades? And I laughed. I'm like, of course I have losing trades. I mean, yes, I have had a really, really good run of late. There's no doubt about it. But yeah, I have losing trades all the time. And here's one right now. MasterCard. So I entered MasterCard on Thursday with a short at 546.56. Why? Well, this is just the opposite of what I just showed you with the cues. This is a bearish order block, meaning we have a high, we have a pullback, we make a higher high, we break structure to the downside, which means now means that I want to start shorting rallies into the bearish order block. Well, that was my trade. On Thursday, it rejected the bottom of the order block. I got short 546.56. Everything's reversed because this is short. I placed my emergency stop 2 ATRs above. And if I get there, how much have I lost? 1% of my account. Where's my end bar stop? A close above the high of the order block at 560.94. Well, it closed at 559.39, so I didn't have to get out of the trade. But Monday, if it closes above the high of this order block at 560.94, I have got to get out of the trade. Here's my 1.5 ATR trailing stop level to the downside. I obviously didn't hit any profit targets because it went against me. So not a good start to this trade, but I'm going to stay bearish on this trade until the market proves me wrong and closes back above. So this particular trade currently down 2.31%. So yes, I have losing trades, and here is proof. All right, let's go to WGS. This is an interesting trade, everyone. Was not planning on taking this trade, but I have a client of mine in New York City, and he's a hedge fund guy and a student of mine, and I taught him about the order blocks and so forth and so on. And we spoke last week about how strong they are. And he sent me this on Friday. He said, Greg, is this a legitimate order block entry? And well, let's look. Did we have a low? Did we have a rally? Did we make a lower low? Did we take out that swing high? Yes. So here is your lowest bar close. The high is 64.25. The low is 58.62. Looking in hindsight, people that bought in that order block, was it smart money? Yeah, it certainly was. But now what happened? We got back to the order block, and you can see this is the order block running into the future. Did it reject the high of the order block on Friday? It did. It went into the order block and closed over the order block. This is WGS. So when he sent it to me, I'm like, yeah, that looks really good, as a matter of fact. And kind of cherry on top, do you see the purple line here? This is the 250-day moving average. Now the 250-day moving average is inside the order block. That's one of my favorite things, favorite confluences, when I have a bullish order block and I have a major moving average like the 200, 250, or 300 running into the order block. So it's a completely legitimate order. I entered at 66.87. My emergency stop is where? It's a close below the order block, 58.62. My end of day stop is 58.62, close below the order block. 2 ATRs below is my emergency stop. What's the orange line up here? The orange line up there is my trailing stop level, 1.5 ATRs above. So just to give you an accurate reading here. So far, not too bad, up 0.57% on the trade on the order block. And so we'll see. And thank you, Tim, for sharing this trade with me. And we'll see how it works. But the key here is that this is a legitimate order. I set everything up. I have a plan. I have no control literally over what WGS or any other stock for that matter does. But I know what I'm going to do. If it closes below the order block, I'm out of the trade. If it goes down and hits my emergency stop, I'm out of the trade. If it moves up the value of 0.45 ATR, I'm going to take a profit. If it moves up twice that, I'm going to take 2 profits. If it gets my trailing stop level, then I'm going to go into trailing stop mode. I don't care what WGS does. I have a plan for it, and that's what you have to do. All right, so that's WGS. Okay, so those are the 3 open positions. QQQ, remaining shares up 14.92%. MasterCard, the short, down 2.31%. WGS up 0.57%. Let's go to the closed out trades that I had last week on the daily. Okay, Microsoft. All right. I had a good entry on Microsoft here on the 22nd of April. Why? Well, you see the green box, you know it's an order block. I got long at 367.10. The previous day we closed below the order block, then we closed back in the order block, 367.10. Emergency stop, 2 ATRs below. My end of bar stop, a close below the order block. I set my trailing stop level here, 388.80. Next day, moves up, I hit some profit targets. Next day, moves up, I hit some profit targets. Also gets to trailing stop level. Next day, nothing. Next day, nothing. Here, I exit the trade. Why did I exit the trade? Because earnings were after the bell. I don't hold through earnings. It's a good way to make a lot of money quickly. It's a good way to lose a lot of money quickly. But as a trader, really what you are is a risk manager. You don't want to put yourself in positions where you can lose money quickly, and holding through earnings is the best way to do that. But sometimes if you sell, you're going to miss out on a gain, which is exactly what happened. It just went roaring up, but it's fine. There are many stocks where I got out of, and then the next day the earnings crashed down. So it all equals out. So anyway, this was a really nice trade, by the way, and I exited for a gain of 7.18%. So that's Microsoft. And then Meta. Let's take a look at Meta. Well, you see the green box. That means it's a bullish order block from the past. I entered here on the 21st of April at 484.13 with rejection of the high of the order block. I placed my emergency stop 2 ATRs below. My end of bar stops are closed below the order block. I placed my 1.5 ATR trailing stop level above. Next day takes off. I hit a profit target. I hit profit targets. Next day, hit profit targets again. Next day, profit targets again. Next day, profit targets again. Can't remember if I hit one here. And then I exited here. Why did I exit? Same thing as Microsoft. I exited because after the bell were earnings, and I don't want to hold through earnings. Of course, in hindsight, I would have held through earnings, but I didn't know, right? But still, wonderful trade for a gain of 11.73% based upon this order block. Okay. So those are the daily trades, both the open and the close. Let's take a look at the weekly trades. So weekly, I also trade weekly bars. Weekly bars close on Friday. That is when I make my decision, on a Friday. So I've been in TLT for quite a long time, actually, all the way back from January 17th on this trade. You see the green box. That's telling you that it's rejection of the order block. And I got long here, 87.20. End of bar stop, 2 ATRs below. Trailing stop, 1.5 ATRs above. Next week goes up a little bit. I can't remember. I don't think enough for a profit. Next week went up a little bit. Here, definitely hit a profit target. Next week, nothing. Next week, nothing. Then we had a nice big move up here where I did take profits, and I am in trailing stop mode. Then for about a month, we just went sideways, did nothing. And then here on January, February, March, April, the 4th of April, we had a big up bar where I did hit more profit targets. And then we had that huge down week where we had all the turmoil in the bond market where I got out. I got out because we had a close below a previous bar's low. So I got out for a loss of 0.59%. But this is a good example of, okay, so it's a small loss, but me taking profits when the market gave them to me, see, that mitigated the losses because it reduced my position size. Next week didn't do much. 2 weeks ago, it was up. This week, it was up and reversed. So I still have half this position, really nothing to write home about, but it is up slightly, the remaining shares, for a gain of 0.64%. Nike, been a fairly decent trade. On the weeklies, I bought Nike here for 18. You don't see a green box, so why did I enter this? Well, this is just a simple deep dip buy. A deep dip buy, I've been trading deep dip buys, teaching deep dip buys for so long, but deep dip buys have to do with the 200-day moving average, the 250-day moving average, the 300-day moving average, or the 30 RSI. And in this, and the negative third ATR channel, which is this gray line here. Why did I enter the trade on Nike here at 55.80? Because during the week, we went below the 30 RSI. At the end of the week, we closed above the 30 RSI. In addition to that, we went below the negative third ATR channel. We closed above the negative third ATR channel. That was the confluence of signals. I entered 55.80. My emergency stop is 2 ATRs below. Where is my end of bar stop? Well, why did I take the trade? Essentially, I took it because it went under 30 and over 30. Therefore, in the future, if it closes back under 30, that's my end of week stop in this case. And have we got to trailing stop level? We have not. Any profit targets? Not yet. So I've been in this trade for 2 weeks, but I mean, it's doing okay. It's up 5.08%. Okay, so that's Nike. Let's go to XLV on the weekly. XLV hasn't really taken off, done a whole lot, but it sure is a strong signal Let's see, you see a green box. That should give you a hint that that's probably has something to do with an order block. Um, and that's true. On the week that I took it, you can see during the week we were below the order block. We closed in the order block. That's signal one. Signal two, look at the black line. The black line is a major moving average. That's the 200-week moving average. The previous week we closed below it. Here we close above it. So this is technically a combo trade of a rejection. It's a combo trade of a deep dip buy, the rejection of the 200-day moving average, and a order block buy, the rejection of the order block. So order blocks, deep dip buys, really, really strong signals, but when they happen together, they're even stronger signals. And by the way, I teach deep dip buys in my one-on-one course. I also have a really good online course available at udemy.com specifically on deep dip buys. And if you're interested in getting that online course, it's 9.5 hours of video. It's really, really good. I've had, I think it has like 4.8 or 4.9 stars. I've sold so many of those around the world. And so if you're interested in taking that, the link's in the description. I think you'll really enjoy it and learn a lot. So I entered this trade 2 weeks ago at 138.03 with the confluences that I just mentioned, the rejection of the 200-day moving average, the rejection of the bottom of the order block. I placed my emergency stop 2 ATRs below. Where is my end of bar stop? My end of bar stop is a close below of the order block. I don't have it marked here, but right about 135.80 is my end of week stop on that one, or end of bar stop, end of week stop on that one. And then I placed my 1.5 ATR trailing stop level above. Hasn't got there, but I did hit a profit target this week when it was at its high, and it reversed back up. So this particular trade, really nothing to write home about. It's doing okay. It's up 0.35%, but I'm still bullish on this until it closes below the low of the order block there at 135.80. So the three open weekly trades, TLT up 0.64%, Nike up 5.08%, and XLV up slightly at 0.35%. So I exited a short trade on DDM on the weekly. I was in this trade a long time. It really was a big trade for me. And but finally my rules told me I had to get out of my short. I shorted here at 103.70 back on 131.25. Why did I short? Well, you see the red box. This means it's an order block. It means that we had a high, we had a pullback, we had a higher high, we broke structure to the downside. So therefore, if we have a check back into a bearish order block, I'm going to short. So I did short here, 103.30. Place my emergency stop 2 ATRs above. My end of bar stops close above the high of the order block. I place my trailing stop level 1.5 ATRs below. If going forward, I hit profit targets, I'm going to take partial profit targets. Next week went down, I hit a profit target. Next week did nothing. Next week went down, and because I'm short, I hit a profit target. Next week didn't do anything. This week here, big bar down where I hit multiple profit targets, and now I am in trailing stop mode. Next week, down again, multiple profit targets. Next week, up a little bit. Next week, started up, closed down. Next week, way down. I hit multiple profit targets. Next week, started down, hit more profit targets, but then I exited half here for a gain of 25.62%. Why did I do that? Well, we went under 30 during the week and closed back over during the week. That was a signal to me that we were running out of sellers. I took half the position for a gain of 25.62%. The next day, the next week, we're down more profit targets. The beginning of the week down more profit targets, then we turned positive, and then I finally exited the trade Friday, the remaining shares on Friday, for a gain on this short of 18.81%. Why? Well, because, you heard me talk earlier about if I'm at 65 RSI, then the five, if I'm long and I get to 65 RSI, and then if it closes below the 5 EMA, I'm out of the trade. It's the same thing here, but in reverse. We got to a 35, we got under 30 actually, right? So at least got to a 35 RSI, and then we closed above the 5 EMA. Here's the 5 EMA, we closed above it. So I am out of this trade. It was a monster trade, 25.62% on the first half, and then I exited Friday the remaining shares for a gain of 18.81%. So those are the trades, everybody. The dailies, the weeklies, the opens, the close, they've all done pretty well except for MasterCard. So I hope you found that helpful. And like I said, if you did, I appreciate if you hit the thumbs up. Let's talk a little bit about trader psychology before we go on and look for trades for next week. Okay, so this trader psychology post comes from my good friend Steve Burns. You can follow Steve on Twitter at S Joseph Burns. He's a great trader. He's a great author. He has great trading books available, Amazon.com. Go check him out. I've read them all. He has a new book out. I'm sorry, I forgot the name, but whatever book comes out from Steve is a good book, and you should read it. So what does Steve say here? Passion helps you start trading. Discipline helps you start winning. And I would probably also write, discipline helps you keep your money. So yeah, I mean, when we first get excited about trading, it's the passion that helps you get started about trading. But passion only goes so far. You have to have discipline also, because the discipline is what's going to help you to start winning, and it's going to help you to be able to keep trading, to keep your money. The passion, yeah, it starts it off, but it's all about discipline. Really, when you boil everything down, everyone, about trading, it's discipline. Following every single rule you have each and every day. Doesn't mean you're going to always have winning trades, but it means that if you have discipline and you follow your rules over the long run, that is how you become a successful, long-term, profitable trader. Without discipline, everybody, forget it. You'll do fine for a while. Maybe you have a good week here, maybe you have 2 good weeks there, but it always ends up where you start having big losses and you never know what to do. Just take my advice. I've traded over 30 years. Get yourself a process and simply mechanically follow it. It's the best way. So passion helps you start winning, but passion does not help you, or helps you start trading, but passion does not help you become profitable. It gets you into the game, but to stay in the game and to start making money over the long run, you need to have discipline. So get yourself a process, learn a process, whether it's from me or someone else, and then follow it. Okay, let's look at some potential trades for next week, shall we? Let's start off here with ARK on the daily. Okay, so ARK almost triggered a signal for me on Friday, and you can see the red box above. That is a bearish order block. That is where I want to look for a short, but I need to see it reject the bottom of the order block or the order block as first. So again, why is it an order block? Well, we have a high, we have a pullback, we have a higher high. Here we break structure and go into a downtrend. So if you're in a downtrend, I want to short rallies back up to the order block. And you can see on Friday, we got very, very close to rejecting the bottom of the order block, but we did not. So going forward next week, if we reject the bottom of the order block at 52.70, or in other words, we go into it, prices, market doesn't like it and closes below, that would be one potential entry. The second entry is if we went above and rejected the high of the order block. Looks like 54.27. So we poke our head above it, close back in. That's also potential short for me. I like this one better. Why? Well, because my risk to reward is better. It just pokes its head above, closes back below, and then the next day it just closes back above. I'm out for a very, very small loss. So risk to reward is very important. Oh, I forgot to mention. Here we're looking at 10 different potential markets for next week. Theoretically, all 10 of these could trigger on Monday, for example. Does that mean I would take all 10 of them? No, it does not. I always, even if I have 10 legitimate signals, I'm going to narrow it down to the best one. How do I do that? Well, if I have multiple markets that have legitimate signals, I assign a score to each market, and then I take the highest score. So how do I assign a score? Well, if one has one entry signal, but the other has two entry signals, obviously that score's higher. It's 2 to 1. So I look at multiple entry signals. I take into consideration the risk to reward. I look at the higher time frames, such as the weekly, to see if I have any signals on the weekly signals. And then I also look at the relative strength of that market, the potential market that I'm going to be trading compared to the rest of the market. This is a very good way. I think taking one trade per day for me has worked out very well. I would recommend it to people. But you give it a scoring system. You give it a report card. Hey, this one had a rejection of the 30. Okay, that's legitimate. But this one had a rejection of the 30 RSI, the 200-day moving average, and order block, and it had a V1. Okay, clearly that one has the highest score. That's the one I'm going to take. And this is what I teach my students in my one-on-one course. I teach them how to differentiate and give a quality score to each trade. And if you take trades that have higher quality scores, you're going to have better results. So like I mentioned at the beginning of the podcast, I would love to teach you all the strategies that I use and have you in my one-on-one course. Like I said, it's 15 hours. It's a serious course. We do it once a week, and it takes about a month and a half, sometimes a little bit longer. But when you are done, you're going to be solid with your trading, I promise you, and I will teach you everything that I have learned over 30 years of trading. So reach out to me, send me an email, and we get the conversation started. So ARK, getting very close, almost got there on Friday, but with some type of rejection at the bottom of the order block or the top of the order block next week, I'll consider taking a short on ARK. Gold. Okay, so you see that I have these two bars up here highlighted in red. Why? Well, this is what is called a bearish island reversal. We gap up, we go sideways, and then we immediately gap down. So if you've been following the channel, you see me take abandoned babies, island reversals, some of my favorite new trading approaches. And what I was looking for, actually, when you have an island reversal, you gap up, you move sideways, and then you gap down. What I was looking for was a kind of a check back or a counter rally back up into the bottom of the island reversal, and I would have gotten short there. Well, look, right here on the 28th, we almost got there, but we didn't quite get there, and now we've gone down. So the bearish island reversal has worked pretty well. I just was not able to take the trade. But I was teaching my student Vivek on Thursday. I was teaching him return to value V1s and V2s. Well, you see the green line here and the green line here. This is anywhere in between the 1 and the -1 ATR channel is considered the value zone. And Vivek, if you're watching this, you will kind of see what's happening here. We were above the value zone where you don't want to buy. You come into the value zone. Now we've had 1 day of sideways motion. I need one more bar of sideways motion, and then the scene is set for a potential legitimate return to value sideways motion V1, V2 entry. So I need one more sideways motion on Monday. If we get that, then I'll be looking for a V1 or a V2 to trigger me into the trade. And if you'd like to learn more about V1s, V2s, go to my YouTube channel. In the lessons playlist, you will see that I have a video there on V1s, V2s. I won't get into it here because it's kind of hard to just talk about in theory. But do you see that, Vivek? Above the value zone, into the value zone. 1 day sideways motion. We need one more, and then a V1 or V2 to potentially trigger me into the trade. Goldman Sachs, GS. Okay, you see a red box, probably means I'm looking for a short, and I certainly am. We had a high, we had a pullback, we made a higher high, we broke structure to the downside, making this a bearish order block, the red bar, and we are approaching the red bar. Now, on this particular trade, there are three levels that I'm looking for. Obviously, a rejection of the order block to the bottom of the order block, a rejection of the high of the order block. So if we look at the order block day, the low is 572.28, the high is 586.89. So either a rejection of 578.21 or a rejection of the top at 586.89 would be legitimate shorts. The third is the red line here at 581. What is that? Again, if Vivek's watching, or Stephen or Pete, my other students at the moment, you will look to the left here. Look at the big down bar to the left here on the 26th. Big down bar. If you rally back to halfway of a big down bar, which is the red line, 581, there's going to be some inherent resistance there. So the way that I'm looking at this trade on Goldman Sachs is either a rejection of the bottom of the order block, a rejection of the top of the order block, or a rejection of the halfway bar, which resides inside of the order block. So I hope that makes sense. So yeah, I'm looking for a rejection of the bottom of the order block, the top of the order block, and the bottom is 578.21, the high is 586.89, or a rejection of the halfway at 581. Altria, MO. Okay, well, you see red, that means bearish order block. Why bearish order block? High, pullback, higher high, break of structure, making this a bearish order block. You can see we are right in it right now, right? And on top of that, so the high and the low of the order block, the high is 60.18, the low is 58.45. We are inside of it. This big down bar here on the 1st of April, big down bar, halfway is going to add resistance, 59.27. That is why I have the red bar here. So I'm looking at two different things. I'm looking either the shorting the high of this order block at 60.18, the low of the order block at 58.45, or halfway of the big down bar inside the order block at 59.27. And you can see on Friday we closed above that halfway, so that's not a legitimate signal yet. So either we go up, reject the high for a potential entry of 60.18, or we just simply close back below the halfway bar here at 59.27. That would also be a legitimate. Short. So lots of potential shorts that I'm looking at, except for Merck. I really like this trade. If you watched last week, I was wanting to get into this trade. But you see a green box down here. That means I'm looking for a buy. Here we have a low. We make a rally, lower low. This day here on the 25th, we take this swing high out, changing market structure to the upside, also defining the bullish order block to the bottom. Here is the order block. The high is 78.69. The low is 75.91. Those are the levels. Here on the 24th of April, we had a big up bar. If you have a big up bar, a pullback to halfway of that bar is a bullish area. So I'm looking for a pullback to reject the high of the order block at 78.69. Conversely, the low at 75.93, that's the bottom, or I could enter inside of the order block here with a rejection of 77.60, One other thing, you see the trend line that I've drawn here? Well, on the 25th of April, we broke the trend line. We broke above the trend line. Very often when you break above the trend line, the market will come back and retest that trend line before it takes off. Well, you can see that the retest of that trend line would dovetail right here in all this area that I'm looking to buy, which is the bullish order block. So I don't know if Merck's going to come back down in here, but if it did, I will certainly watch it closely. And if it rejected the high of the order block, the middle of the order block there, or the bottom of the order block, that would certainly be a potential entry for me. Really like that one. Let's go to Palantir, PLTR. Okay, well, this thing took off like a rocket ship. It's funny. I had a friend of mine contacted me last night about, hey, what do you think about PLTR? I said, oh yeah, I've been looking at it. He goes, oh, to buy it? I'm like, no, to short it. He goes, short it, I heard it's really good, and da-da-da. And I said, well, yeah. It's gone up a lot, but I said, I certainly wouldn't be buying it up here. He goes, how come? The news is good. Yeah, why not buy it down here? Look, we basically touched the bottom of the bullish order block. That was the place to buy it. I'm not going to be chasing it up here. So look, earnings are here on the 5th. So I'm not going to get involved until after earnings. But look, here is the previous order block up here. This, when we were down here, was this a good place to sell? Yeah, it certainly was. Well, now we're right back up there. So after earnings, if we reject the high of this order block, I would potentially get short. If we reject the low of the order block, I would potentially get short. And let me give you the levels. The high is 125. The low is 118.43. I'm not going to do it before earnings. But if after earnings we have a solid rejection of the high of the order block or the low of the order block, I would get short. And if earnings are great and it goes blasting off, then I just won't mess with it, right? Just need the rejection there first. Let's go to QLD. QLD is double leverage Qs. Honestly, on Friday, I'm in the Qs. But if I was not in the Qs, I would have got short the Qs on Friday. Why? In a little bit, I'll take you back over there. But this will probably give you the answer. QLD basically tracks QQQ. It's just double leverage. Well, look, here's your order block back on the 25th of March. Highest bar close, market structure change. If we get back there, looking for a short. So I'm looking for a short of the low of the order block, 97.47, the high of the order block, 98.70. And you can see the 300-day moving average is not quite residing in the order block yet, but very, very close. So just that 300-day moving average by itself would be resistance, let alone the order block above. So just to be clear, for me to get short QLD, I'm looking for a rejection of the 300-day moving average, which is 96.97, and or a rejection of the bottom of the order block, 97.47, or the high of the order block, 98.70. You have a lot of resistance up there. You have a lot of major moving averages. You have the order block. And we've had a hell of a run, right? Now, just because you have a huge move up, you just don't short. And that's not what I'm saying. But I'm saying technically there are some major resistance levels up here in addition to having a big move up. RBLX. Well, that certainly went up. We're in the red box. That means I'm in a shortable area. Look at the 200-day moving average down here. That's a deep dip buy, right? There's your entry right there. Rejection of the 200. Did that one work? Yeah, I'd say so. But now we are getting into a major order block. You can see we closed inside the order block. The low is 73.47. The high is 75.74. We have not rejected the bottom of the order block, right? We closed inside the order block. But going forward on Monday, if it closes below the order block, that's a potential short for me. If it goes higher, rejects the high of the order block, that's a potential short for me. So the levels on that order block: low 73.47, high 75.74. Let's go to the SPY. Okay, S&P 500. Okay, absolute textbook resistance. Back here is your order block on the 25th of March. Change of market structure, defining this order block. World coming to an end because of tariffs. Oh, never mind. Really wasn't that big of a deal, right? But now look at this. The low of this order block is 573.69. The high is 576.41. What is dovetailing right there at the bottom of the order block? The 200-day moving average. That is a significant amount of resistance right here. Does it mean it has to be resistance and go back down? No, it can go through it. And if it goes through it, it goes through it. But it has not proved yet that it can go through it. So I am certainly looking for a short up in this area. It's a very narrow order block with a very good risk to reward ratio. So I'm not predicting that it's going to go down. I'm just saying if the market does go up, reject the bottom of the order block, reject the high of the order block, or reject the 200-day moving average, now I've got a really good risk to reward ratio at a confluence area of resistance. May not work, may just go up, boom, I'm out. But if I'm right, then I have the potential for a big move down where I was only risking a little bit. Make sense? On SPY? All right, let's go XLRE. Again, inside of an order block. Highest up bar close before market structure change. We are inside of the order block right now. The high of the order block is 42.17. The low is 41.60. If I reject the high of the order block, I could get short there. If I reject the low of the order block, I could get short there. Okay, those are the dailies. Let's head over to the weeklies. And I've got 4 here on the weeklies. Here is Bitcoin, or BITO, I should say. Really perfect market structure change. Look, we have a low, followed by a rally, followed by a lower low. And then 2 weeks ago, we changed market structure to the upside, defining the order block to the downside. The high of the bullish order block is 1835. The low is 1648. So a rejection of the high of the order block at 1835 would be a legitimate long entry. Rejection of the low would be 1648 would be a legitimate long entry. And then I have the green line. What's the green line that's inside the order block? This halfway of this big up bar. If you go up, a pullback to halfway, you're going to find inherent support. That inherent support resides in the order block. So basically anywhere the rejection of the high of the order block at 1835, the rejection of the low of the order block 1648, or a rejection of the halfway bar here at 1748, I will potentially get long here because we've changed market structure to the upside. And when you change market structure to the upside, you want to buy dips. When you change market structure to the downside, you want to sell rallies or you want to sell reps. Okay, CCJ, nice market structure change on CCJ on the weekly. Here's your low, followed by your high. Here's your lower low. This week took out the swing high. This changes us into a bullish market structure. Therefore, I want to buy dips with the rejection of the order block of the high, 42.63, the low, 36.43, or 38.40, halfway of the big up bar on 411. So I'm looking for a dip on Bitcoin. I'm looking for a dip on CCJ, Cameco, because they are in bullish market structures now, looking to buy dips. Tesla, okay. Same thing. We have a low, we have a rally, we make a lower low. This is your swing high. Last week, Tesla changed market structure to the upside by taking out this high, This now defines the new order block here. The high of the order block is 284.99. The low of the order block is 236, the high and the low of the green boxes. Inside of the bullish order block, we have the 200-day moving average. I love when you have a major moving deep dip buy like 200, 250, 300 inside of a bullish order block. In addition to that, last week we had a big, huge up bar on Tesla. Halfway of that is going to find support at 254. So next week, if we pull back, we reject 254, I very likely would enter long. If we reject the 200-week moving average at 249.90, I would very likely enter long. If we reject the low of the order block at 236, I would consider entering. So essentially, I'm looking to buy Tesla with some type of deeper pullback into this order block. Last but not least, everybody, XLF, looking for a short because of the bearish order block. We have a high, we have a pullback, we make a higher high, we break structure to the downside. It defines the bearish order block, the high of 52.26, the low of 50.30. That is the high and the low of this red box. The next week, huge moves down. If you rally back to halfway, usually fail. Look right here. Big move down, down. We rallied to halfway, and that's all there was. Now we are coming back into these levels. So if we reject the low of the order block at 50.30, I would potentially take a short there. If we reject halfway of the big down bar that resides in the order block at 50.60, I would consider shorting there. Or if we rally all the way back and reject the high of the order block there at 52.26, that's up here, then I would look to get short there. So last but not least, I just want to show you the cues. And again, I am in this position at the moment, but boy, if I was not in this position, I certainly wouldn't take it here. And let me explain why. Here is your top order block. Here, high, pullback, high, market structure change. This is your order block here. It's a very narrow one, 493.62 to 490.42. Okay, so rejections should be shorted in that area. In addition to that, look at the black line. That's the 200-day moving average. That by itself is a major level of resistance. What did we do on Friday? We rejected the bottom of the order block, which just by itself is a legitimate short, and we rejected the 200-day moving average. So again, I'm short. I could certainly make the course, and I could certainly make the point in a court of law that I'm exiting this long. When I'm in a position, I just run it out the way that I originally constructed the trade. However, if I was not in this long position, ironically, I would have shorted the cues on Friday because of the rejection of the 200 and the rejection of the bottom of the order block. So I know everything's been great this week. Everyone's excited. Market's up, so forth and so on. But, remember, technicals matter, and we are at a major level. And more importantly than that, the cues reacted to that level. You saw the sell-off at the end of the day. It's because we got to those levels and the market reacted. So be careful. For God's sakes, don't go chasing stocks right now. I mean, I guess do it if you want to, but me personally, I wouldn't do it because we are in some major resistance levels. So keep that in mind. Listen, if you want to become a student of mine, send me an email. I'd love to work with you. I love to teach. I've turned out some great traders from all over the world. I'll teach you everything that I know about trading, and every single student I've ever had has been, Greg, I'm so glad I took this course, and you will be too. So send me an email. It's in the link of this YouTube video. If you're interested in the online video course, the deep dip buys, that the Udemy link is in the description. Start off with that. You'll love it. You're going to learn a lot. If you have any questions about this podcast or anything I've gone through, please put them in the comment section. I'll do my best to get back to you as soon as I can. I hope you have a good rest of your weekend. Go out and have a nice weekend. Try to go out and do something nice for someone every day. Try to go out and do something nice for an animal every day. If we all did that, the world would just be a better place. But if you've made it all the way to the end here, thank you so much. Appreciate your support. If you found something valuable, please hit the thumbs up button. If you haven't hit the subscribe button, hit that as well, right? But again, thank you for your time. Thanks for investing your time. I hope it's going to pay off. Be careful next week. Follow your rules. If you don't have rules, get yourself rules. And God willing, I'll see you next week. Thank you so much, everyone. Take care of yourself. Bye-bye.
U.S. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.